Hello everyone, this is 1 Minute Markets with my first long form video. Today we'll be spending 8 to 10 minutes talking about why we should not be buying the dip necessarily with this latest bear run. And to do this, we're going to have an overview of 6 companies and why I feel that buying the dip may not necessarily be the most prudent investment strategy yet when it comes to this bear run. There is still a great deal of market uncertainty from Brexit to trade wars, to stuff going on at the border, to the split Congress, to the Fed's potential rate hike in December and their outlook for 2019. So it'll be important for us to correctly navigate this current investment climate and make prudent investment decisions that will benefit us moving forward. Starting out with Apple, everybody knows Apple's famous bull run over the past few years, becoming a $1 trillion company, stock price getting up into the 230 range. And it's really come crashing down since then over the latest bear run, falling all the way down to $172 a share. As you can see on this 3-year chart here, it's almost like a falling knife. And a lot of companies that you look at in the market today have a similar chart to this of sort of, a decent bull run as we've had over the past few years, all the way up to the peaks at the beginning of October, end of September, and then sort of just like a falling knife over the past month and a half, 2 months. This is not the type of chart you look at and view as a buying opportunity. Now, personally, and I'm not giving any investment advice, I think as Apple gets closer to that 170 number, it becomes a more attractive investment. But we really don't know where the floor is here. Is it at this level of support right here at 161? Is it down here in the 150 range? Or could it even come all the way back here to the 149, 143 range? We are not sure at this point. I would think that the next week or two will provide a great deal of clarity on Apple specifically. And I do think that the company has been oversold, as I think most of the companies have in this recent bear run, and I would expect a market recovery. The key is just determining when, and you don't want to get in here if you're buying, if the stock is actually going to go to here before it starts to take off again. Now moving on to another company we're going to go to, another company that has issues like Facebook with their or Apple with their iPhone sales. We're going to go look at Facebook right here. Now Facebook is a little bit of a different animal from Apple, just based on some of the scandals they've been involved in, with the election, with some of the things that Zuckerberg has been doing. But as you can see, still this same sort of pattern of just going down, 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 and we're not really sure when the bottom is here. There is this here at $115 a share. I'm not a big believer in chart reading, but I just think it's important to show that the traditional buy the dip view of Wall Street may not be the best situation for this recent bear run, just because of how aggressive and how fast these prices have collapsed. What we're going to look to see is something like this, I think, is that what we want to see before investing into Facebook. We want that sideways movement, and then maybe, we could see another, bull run on Facebook. But as of right now, just with everything going on with the company and the way the market has been right now, I would not recommend buying the dip on something like this. We could also go into Netflix. Netflix is pretty unique because they had a phenomenal quarter this past quarter, but still a victim to sort of this steady decrease down here, and we're not sure when the floor of Netflix is, and it's a pretty common theme here. But now that I've been through 3 tech-oriented stocks with Apple, Facebook, and Netflix, I just want to show you an example of how this is applying across the board. And we'll go into Home Depot here. Pretty safe company, very strong and stable cash flows, a company that's always going to be there. Whether it's been the housing market and the issues that it's had, but Home Depot has sort of been the same thing with this sort of falling knife. They reported strong earnings here, but then they came right back down to the pre-earnings levels. And you've seen that with companies like Best Buy and all these companies. It seems like this bit of a falling knife effect, and if you drop a knife, you're not going to try to catch it, you'll cut yourself. So I think that's important to look at when we're looking at these companies specifically. We need to be very careful because you don't want to buy right here and then it ends up going down to here and you're already out 10-15% on your investment when you could have waited. I think we need to see this horizontal movement in a lot of these companies before we start buying again. And again, I want to stress that I'm not making any investment recommendations here. I just merely want to set an example of why we're seeing what we're seeing in the markets and why now may not be the best time to put money in. We'll also take a look at a company like Walmart here. Walmart has been doing well through this run just based on Black Friday. And then they didn't have the greatest earnings report, and they took a nosedive. So it shows you that some companies can get through it. Retailers specifically in the holiday season are going to be favorable. But with this right here, I wouldn't be surprised if it comes back down to this level in the high 80s. But, this is just an example of something that might be contrasting the fact. But, a company like this, you may feel as attractive at $95 a share, and you may want to buy some. And I think that if out of anything that I've shown right now, this is a company's chart that looks pretty decent through this fall. And now we'll look at an oil company, Valero. And obviously everybody's followed oil recently, the collapse of oil prices and anything that's been going on in that industry. My background is in the energy industry, and we've seen just oil stocks getting clobbered as of late. I mean, Valero was as high as $125, $120 a share, and now it's all the way down in the 70s. Might not be that long before it's half of its high if oil continues on the route it's going. But we can just see again this falling knife effect. Now, this is another company like your Apples and Facebooks that has had industry or company specific, detriments to it as why it's going down. But again, it's just another example of it may not be smart to be buying the dip here. Even if we go over to Best Buy, even going over to Best Buy reported really, really strong earnings. They had a good quarter, and even they're falling, just being tech-related and everything, they're falling down to this knife. We're going to take a look at a company like a foreign Chinese company with the Chinese-U.S. tensions, like Alibaba. Look, they're coming down. Now their chart's starting to move sideways. Could be potentially a buying opportunity. Maybe they found their floor. But again, if you see these aggressive sell-offs, don't think that buying the dip is like, oh, man, end all be all. If I buy the dip, it's what Wall Street has always said. You're going to profit off of it. That is not necessarily true. You want to be able to time this right. Like if you bought the dip on BABA right here at 188 coming off of, almost 211, you're sitting down in the 150s right now. You lost a lot of money on that investment. So just be very careful when buying on the dip. There are companies, and I think every single company I showed you in this are companies that are strong companies that will continue to have strong cash flows. And from there, we just need to make a determinant of whether we think that it's fairly valued. And, that's not just company specific. You also need to look at market specific and what's going on in the country, what's going on in the world. And all these factors have to go into making a wise investment decision. And with everything going on in the United States, in China, in Europe with Brexit, there's a lot of factors that go into making investment decisions right now. It's a very interesting climate, and hopefully December with the Fed meetings and the Brexit deal, hopefully we get a little bit more clarity on what we can expect entering 2019. And this bear run can end soon, as I'm sure there's plenty of buyers waiting to get into the market right now at current valuations. It's just a matter of seeing, is this the floor? Have we hit the floor? And I don't think anybody can answer that question. That's all I have for today. I hope you guys enjoyed something a little different, a long-form discussion here. Please feel free to comment, subscribe, and look forward to speaking with you all tomorrow morning on some market news.